Alright, so for this video, we're continuing our discussion of topic 958, not-for-profit entities, and subtopic 30, split interest agreements. And so in the prior video, we discussed in the recognition subsection in relation to revocable split interest agreements. So here we're going to be taking a look at irrevocable agreements. When we are the ones, as the not-for-profit, we're the ones that are holding the assets in the agreement. But under an irrevocable split interest agreement, the assets could be contributed by the donor to either the not-for-profit entity or to a third party who would be the trustees and distribute the assets as the agreement states. So what's different from the prior video and revocable versus irrevocable? In the irrevocable agreement, the donor can't take the assets back if they want to. So those assets would be considered in custody or in control of either the not-for-profit or the third party, whoever the donor sent the assets to. And so that gives us the ability to recognize them when received. So in this video, we'll specifically discuss recognition when these assets pursuant to that agreement are held by the not-for-profit entity. So it says here that in absence of donor-imposed conditions, the not-for-profit should recognize contribution revenue and the related assets and liabilities when it is named the trustee or fiscal agent in an irrevocable split interest agreement. And that should be recorded when the assets are received. And as we saw in the prior video, that if those assets are investments, they should be recognized in accordance with subtopic 320, which we'll get to in a later video. But the point of this is that since this is an irrevocable agreement, we'll go ahead and recognize a revenue for the portion that is considered to be a contribution to the not-for-profit entity. And they tell us to take a look at this section, other presentation matters, and we'll take a look at that in a later video. But these assets held by NFP section is split into two types of split interest agreements to explain specific items in relation to them. So we have split interest agreements other than pooled income funds or net income unit trusts, and then also pooled income funds or net income unit trusts. So including pooled income funds and unit trusts, and then excluding them. And so these subsequent paragraphs, which we'll go through, are describing the ways to recognize these specifically. First, split interest agreements that are not pooled income funds or net income unit trusts. And some examples of these would be the charitable gift annuity, charitable lead trust, or charitable remainder trust, as was defined in some prior videos. These types of trusts have some assets in them for which the not-for-profit holds that are actually intended for the benefit of others that the donor has designated. And so that means that we're the trustee of those assets and have control of them, but they're actually other people's or other entities' assets, and therefore we need to record a liability for the future payments to be made to those beneficiaries. And we need to record that liability at the time that we receive the assets and have recorded those assets on our book. And so some of these agreements might contain embedded derivatives, which are explained in subsections 25.7 through 14, and we'll get to that in a subsequent video. But for now, we want to understand high level how or where and when to recognize the split interest agreements when the assets are held by the not-for-profit entity. So we just discussed other than pooled income funds or net income unit trusts, but now let's go down and discuss pooled income funds or net income unit trusts. And that's down here at subsection 25.15. And it says that not-for-profit will record the assets received from the donor under these types of agreements when they receive those assets. And they also recognize a rep contribution revenue in the period in which the assets are received from the donor. And so then the difference between the assets that it recognized and the revenue that it recognized is recorded as a deferred revenue because that's the discount for its future interest that it hasn't yet earned.